KOSPI falls 1.55%. Welcome back to The Explainer. Today, we're diving into a sudden, highly aggressive market reversal over in South Korea. And as always, our cute little mascot Loro is here with us to help track exactly how these dominoes fell. Let's get right into it. So this is really a story of massive global forces just completely overriding local momentum. We're looking at a classic global domino effect. Basically, geopolitics triggered a commodity spike, which then fueled inflation fears, surging bond yields, and finally, bam, it all crashed right into Asian equities. Now, the crazy part is, the stage was perfectly set for a massive tech rally. The KOSPI had previously closed up over 2%, and it actually opened higher thanks to some really strong U.S. semiconductor momentum. But halfway through the trading day, the underlying macroeconomic ground just completely shifted, and the index violently reversed course. And the final damage? Well, it was severe. The KOSPI dropped 1.55%. To put that into perspective for you, out of 942 listed stocks, an overwhelming 682 of them fell all at once. Mid-cap stocks took an especially hard hit, closing down 2.5%. So you gotta ask, how on earth do we go from a massive tech rally to a broad market bleed in just a matter of hours? We have to zoom out. The dominoes actually started falling all the way over in the Middle East. The 60-day U.S.-Iran ceasefire memorandum officially expired. Right after that, reports confirmed that a UAE-owned tanker was detained in the Strait of Hormuz. If you follow energy, you know this is literally one of the most critical energy supply checkpoints on the entire planet. The number of vessels safely transiting that strait plummeted from a 5-day average of 12 all the way down to just 3. Of course, the global market reacted to this supply chain bottleneck instantly. WTI crude oil spiked to $85.42 per barrel. When transit volumes through a major checkpoint like the Strait of Hormuz just collapse like that, the market immediately prices in a severe crude oil shortage. No hesitation. Okay, so what does this all mean? The absolute crucial point here is the rapid cause and effect chain this creates. Rising oil prices instantly raise energy import costs, right? Higher energy costs then raise corporate production expenses and everyday household spending. This directly fuels both producer and consumer price inflation. And when inflation expectations go up, central banks are basically forced to hold interest rates high. The market saw that oil spike and immediately priced in a much higher probability of prolonged elevated interest rates. And here is where the next domino falls: a totally synchronized surge in global bond yields. The U.S. 10-year Treasury hit 4.722%, and South Korea jumped right up to 4.383%. Remember, rising yields make government bonds a highly attractive, safe alternative to volatile stocks. They act like this massive vacuum, just pulling capital straight away from equities. But honestly, the loudest alarm bell was ringing in Japan. Japan's 10-year yield hit 2.945% intraday. Guys, that is the highest level we've seen in about 30 years. This drastically shifts the relative value of fixed interest income across all of Asia. It's a huge deal. Let's bring this all back to Seoul. When Korean and U.S. bond yields rise, it increases the discount rate. Think of the discount rate like gravity weighing down future profits. Growth in tech stocks, whose massive valuations rely so heavily on future earnings, get severely punished by this rising gravity. And this sudden valuation shift triggered automated panic. Algorithmic program trading unleashed massive, simultaneous selling pressure, dumping 1.09 trillion Korean won. It's this blind, lightning-fast execution that drags the entire market down, completely ignoring individual company fundamentals. The algos don't care, they just sell. And human institutions? Well, they followed the algorithms right out the door. We saw heavy selling hit the absolute core of South Korea's economy, the technology sector. Institutions net sold 785 billion won on the KOSPI. This marked the second straight day of heavy institutional selling, and the specific targets they chose were actually really telling. They rapidly offloaded the absolute titans. Samsung Electronics saw 257 billion won dumped. Samsung Electromechanics and SK Hynix took massive hits as well. Just to give you an idea of the scale here, selling in just 4 major tech stocks made up nearly 75% of the total institutional net selling for the entire day. But hold on, here is the hidden signal buried within all this chaotic selling. While domestic institutions were dumping tech completely blindly, foreign investors were executing a highly strategic rotation. We're calling this the Great Chip Divergence. There was just a massive difference in how foreign capital treated the two memory giants during this exact same crash. To understand why, you have to look at enterprise AI. Anthropic just disclosed preliminary second quarter revenues of $11.5 billion. That is a 14-fold increase from last year, 14 times. This proves that enterprise AI isn't just hype, it is rapidly converting into real revenue, which means massive, concrete orders for data center compute. This incoming wave of data center demand sets the stage for a brutal battlefield between Samsung and SK Hynix. Both of these companies are racing to supply the high-bandwidth memory chips required for these intense AI workloads. But as the numbers tell us, foreign investors have clearly picked a favorite in this specific macro environment. The data shows a really stark difference. Foreign investors executed this relentless 4-day accumulation of SK Hynix, totaling 3.93 trillion won. They bought aggressively every single day. In contrast, the flows for Samsung Electronics were totally indecisive. They were alternating back and forth between heavy buying and heavy selling over the exact same period. So what was the result? Foreign capital completely absorbed the panic for SK Hynix. Despite the massive macro drag, the surging bond yields, and all that algorithmic program selling we talked about, SK Hynix completely defied gravity. It actually closed in the green, up 1.03%. Now, contrast this directly with Samsung Electronics. Lacking that same relentless foreign defense, Samsung fell victim to the broader market index drag and the algorithmic program offloading. The stock closed down 2.19%, mirroring the pain felt across the wider KOSPI index. Which brings us to the absolute core takeaway for this explainer. Macro overrides micro. You can have incredibly strong sector momentum, you can have a great company, but when global supply bottlenecks hit and bond yields surge like we just saw, that macro wave is going to crush local corporate momentum almost every time. Just look at the broader market. The heat map tells the whole story. Aside from a few isolated pockets of green that were driven by that targeted foreign accumulation, it is just a sea of red. When 10-year yields spike simultaneously across the globe, the automated systems take over, and the broader market just bleeds. So if invisible macroeconomic forces can wipe out local corporate momentum this rapidly, is your portfolio actually prepared for the next global domino to fall? If you would like to receive news on the closing of Asian stock markets before the New York stock market opens, please subscribe.